Welcome everyone to Now Next Later for Monday, April 7th. Sasha, how's it going? Good to see you.
Great. Good to see you too, Jer.
We're joined by Skye Laudari. Skye, welcome to Now Next Later. You are the co-founder of Crib Equity. Last week on Now Next Later, Sasha and I talked a lot about first-time homebuyers. What's the data say? How are they looking at the market? What opportunities may or may not exist? We even got into questions of shared equity, shared appreciation, and co-buying. And so as I intro slowly here so that everyone can come over from the waiting room who joins us live. Those are our OGs, our true fans who come in every week live, and we appreciate everyone who watches on YouTube afterwards and watches on LinkedIn. But those of you that join us live, thank you. As usual, we'll keep the chat open. We'll talk to Skye and jump right in. Skye, one of the things that we should start with in the now is maybe a lot of people haven't heard of Crib Equity and shared appreciation products. So if you could just give us a little background on the company, starting it, and maybe the primary offering, and then we'll get right in with our questions.
Absolutely. Thanks, Jeremy. And Sasha, nice to be here. I'm excited about this fancy backdrop behind me today. So pleasure to be having the conversation. Okay, I think one of the things that we also just need to normalize on a little bit is what it is we do. Is it shared appreciation? Is it shared equity? Is it co-investment? There's a lot of different names out there. I can at least speak to how we think about it at Crib Equity, which is a little bit more along the lines of shared equity because we've taken a position that the parties co-investing with a home buyer should be on the same terms as that home buyer. And so rather than a top line appreciation, we're really thinking about net, and that is the equity value for owners in a home. So, first time home buyers, we could talk a lot about that. It seems like you already have. Also, this product was built in large part due to my own challenges and inability to become a first-time home buyer, and realizing that the bank of mom and dad is not available everywhere. And again, not to knock that, I would love to be able to do that for my children at some point in the future, and like everyone should if they can, but most folks can't. And so I joke that we're the rich parents you can adopt when you want to buy a home. So we invest equity into the down payment right alongside a home buyer. There's no payment to us or our investors for that investment. In exchange, they're just taking an ownership share of the property, just like the resident homeowner is. We do it under a TIC, so we're actually creating shared or co-ownership of the property, and then that investor is going along for the ride with the home buyer in terms of what happens to the future value of the home.
So for those title nerds watching, that's tenancy in common.
Mhm.
But for everyone else, let's walk through Skye one example of a first-time home buyer comes to Crib Equity and says, I have some money for a down payment. How much do I need? How much does Crib Equity participate? And then what's my first mortgage product
Yeah.
like today?
Yeah. So, I mean, we could probably talk about a couple different scenarios. There's the mechanics of it, and then there's the why of it too, right? So the mechanics of it are that we have today home buyers bringing 10% down from themselves, from their own capital. We can then match what they're doing on a dollar for dollar basis. So that's inclusive of some of their closing costs as well. So if they're bringing 10, we'll bring 10. That also scales. A home buyer wants to bring 15 or 20% down, and they want another 5 or 10 or 15 from us. We can do that as well. It's also possible that they bring 15 and they want 7. It's not a requirement that we match. That's just the high water mark right now. We go through a basic pre-approval process with them. With our lending partners, we want to know that they're actually mortgage qualified and ready and far enough along in the purchase process to take those steps, because unlike other assistance programs, our contribution is so meaningful, and in some cases critical to the home purchase, that you need to know it's there. So we actually commit our capital up front before someone may even enter into a purchase contract. So we need to know they're a committed buyer, at least more so than doing Zillow surfing, on a Thursday night. So once we commit our capital to them, they go out, work with their real estate agent, they pick the home, they set the offer price. It really proceeds just like a standard transaction, knowing that we have our commitment letter to fund them, just the same way that, in some sense, you would take a gift letter to say, hey, I have these extra funds for my purchase. We fund into escrow. Again, very analogous to like a gift, and then property closes, and that's how we roll.
Sasha, one of the things that we talked about last time that comes to mind here is about like who contributes what and who verifies what. And I really like this idea of these funds are as effective, if not more effective than gift funds, because to me, this sounds like a lower risk, right? Like a gift is a gift. Your parents are going to do it as Skye said, like if you can get it, you should. But when another entity, especially one that has, to make a profit and has investors and has to run a fund, says, I'm in on this too, I think we're dramatically lowering the risk. And one of the reasons I bring it up is because when we talk about that first mortgage, I like to draw the distinction because it's one that gets under my skin, which is it's non-agency, but it's not non-QM. This is not a higher risk loan. It's just that the Fannies and Freddies of the world don't buy it yet. But the actual verification data here, what the LTV looks like, what the DTI looks like, the fact that you have additional capital in the mix actually lowers the risk to the investor. So non-agency, but not necessarily non-QM, may or may not be. But that was just one clarification I wanted to make, here.
Skye, who do you see as like typical investors for the capital for this?
Yeah. Well, I guess there is a now next later to that story too. But
Sorry.
today, it's larger investors, right? So it's not a retail product.
Okay.
We're high net worth individuals, family offices, institutional investors, and the benefit for them is that real estate as an asset class is very difficult to get into, particularly residential and single family, without high acquisition costs, steep management costs, operational overhead, all those kind of things. And so to be able to, in some sense, passively enter that market in a diversified fashion is something that provides great exposure to the asset class. And so they can essentially get the underlying equity without, they're not getting a current yield, but that's attractive in and of itself.
And
And
how does
maybe,
that partner, sorry, go ahead, Jer.
no, please.
I say, how does that partnership work? Like, do they just say, hey, this is how much we want to put in and, what type of portfolio we want, and then you go manage it? Or do they have more say in, what they say yes to, no to? Is it by transaction? Like, how does that work?
Yeah, so we allow those investors to articulate some of that strategy that they want. So it's very high level. It could be geographic specifications. It could be what they want to see in terms of the down payment from the home buyer. It could be maximum home values, or frankly even minimum home values, and in some areas, although those are somewhat self-correcting numbers just based upon how the product will work against other attributes that they want. Once we have that loose criteria, then we use that to just deploy their money. So they're not actually looking at individual homes and addresses and borrowers and saying, hey, here's a file. Do I want to invest in this home? They're investing in a archetype of that transaction, and then we execute it on their behalf.
And then to Jeremy's point, I know it's non-agency now, but I assume you're working towards that. So how is that looking? How is it going? How are we feeling timing wise?
Yeah, so uh, we were very thoughtful about this as a place we want to go with the agencies over time. I mean, I think it obviously expands the opportunity so much more broadly to a whole nother set of buyers and borrowers in a way that makes sense for them. We designed our product based upon agency guidelines.
Nice.
And if you and I wanted to enter into this transaction today, both as individuals, that is an agency product. But we're also very mindful of the fact that to do this at scale and to be able to support the number of home buyers that we ultimately want to, the investors aren't going to do that individually. And so they need some sort of entity or vehicle to put their investments in. And that's where the agency guideline issue breaks down today. So the actual architecture, we meet or exceed all of the guidelines that the agencies have set around shared equity. It just depends on who the parties are in the transaction. And that's the thing that we need to work towards. I won't sort of take a guess at exactly where that falls on the timeline, but I do think that the the time and the need is now. And so that certainly is part of the conversation.
Yeah, we can put one foot in now and next at the same time here on this show, Skye. And
Okay.
yeah, so Alan, submitted the question that you just answered, which was, so it can be or is based on Fannie Freddie guidelines. When I did the deep dive on specifically Freddie Mac's guidelines, it seems like the only provision, Sasha, is who can contribute that money is limited to certain nonprofits of a certain type. And all that would have to change is anybody can submit those funds as long as they meet these criteria, which could be the same criteria as a nonprofit or not. But the point is, that provision is all that would really need to change. So it's kind of what's next could easily be conventional in a variety of contexts. Skye, you've kind of talked about a bunch of the different pieces, the components of the product, the investors, what Crib Equity does. Can you walk us through? We have a lot of lenders who watch this show in order to enable loan officers to do new things and to do different
Mhm.
things. What's the message to loan officers? How do you want them thinking about this product?
Yeah, it's a great question. I mean, we think very deeply about how to partner with loan officers and enable them to expand, their business, but also better serve their clients. And so I think one of the ways that I would answer that is just to think about how their clients could use this and how their clients can benefit. And I think great loan officers are then thinking about the framework, framing how to use our product in the context of how it actually serves their clients. And so the ways in which we see this use is obviously it expands the qualification box, right? Because now you've got someone with more, more cash to put down, less debt, in many cases that, a rate improvement as well. And so now the entire qualification of that borrower looks different. So again, that means getting into the market. It means increasing your budget in the market, whatever the goals are for that borrower. I think the interesting thing that we're seeing emerge as well is that this is the first time that a level of flexibility around home purchase has been presented to people, where there is a trade-off that never existed of how much money do I want to put down versus what I want my monthly payment to be. And so within that context, there's this question of, well, I have 20% down, but what if I took another 10 and now I have 30? What does my payment look like? Do I feel better about that cash flow today? Does that make me feel more secure? Or maybe I have 20 or 30, but what if I want to hold cash because I want to use that for something else? I want to invest it somewhere else. I need to liquidate funds that I would prefer not to move out of some other account. Certainly I think that always can make sense when you're looking at a retirement account or accessing 401k or other investments where there's tax consequences. And so there's really this flexibility. A lot of small business owners and families, frankly, that are like, I'm parting with a lot of money. I don't feel secure doing that anymore, particularly in an environment where we're entering into right now, where there's some sense of economic uncertainty. And maybe that's an understatement, but like holding on to cash, reducing your or improving your cash flow on a monthly basis, those are all things that are resonating with the buyers that we're seeing. And so, when we buy cars or we lease cars, we're all used to that slider on the website, right? That's like, how much do I put down? What's my monthly payment? Home buyers have never been presented with that option because, frankly, who has that level of liquidity to be like, do I want to put $100,000 down or 150 or 200? Like, that's not a scale that most of us have access to thinking about with how we want to structure a home purchase. And so for the first time, that's really available to people.
Yeah.
My understanding that, sorry, go ahead.
No, we're both excited about this. Like
Yeah.
I was just going to make a cash is king joke because our
Do
industry
it.
says that, but then doesn't honor it. So
Yeah.
please, you go ahead.
Yeah, that's true. Debbie Downer, just kidding. When you think about the typical customer that you're getting in, and I think about down payment assistance programs that are out there today, like, is there a difference in the type of consumer you get, or is there just a general difference in the offering you have compared to those down payment assistance programs? And can you talk about that?
Yeah, definitely. So the buyers that we see today tend to be sort of median home price and up.
Yeah.
And there's several reasons for that. Largely due to either that the programs that would assist people, there's a lot of areas in the country now where you price out of that index based on your income. So you earn too much to qualify for assistance, but you don't earn enough to buy a home where you are anyway. So there's a sort of, workforce housing middle income gap. And then there are folks who, frankly, are buying at a level where a down payment assistance program is always helpful. You don't want to turn the money away, but it's not meaningful enough to actually change the economics or enable you
Yeah.
to do something that you couldn't do before. And so, with our ability to write $100,000 check or a $200,000 check, those are sums that are that are substantial enough, particularly in metropolitan areas, higher price point areas. So that's typically the home prices we've seen is kind of anywhere from 500 up to about $1.5 million tends to be our sweet spot thus far. But I think there's flexibility to go both directions from there.
Yeah, interesting. And it's, it's a good point because the difference in what you get from a down payment assistance amount compared to what you're talking about is, to your point, meaningful. And that's another loan officer plug for monthly payments, right? Like your monthly, like the first concern for most home buyers that are struggling are figuring out how they're going to find that down payment, right? And then they got to qualify. And then once that's done, it's kind of like, okay, now can I afford monthly to keep up with this, especially given all the other rising costs that we're managing both within mortgage and outside of.
Yeah, we've seen scenarios where the monthly payment drops as much as 25% or even a little bit more, which when you think about that,
Yeah.
that's substantial in terms of lowering someone's qualifying income 25% in order to get into a home. I mean, think when you ask the question about, the GSEs and kind of that next framework, it just so happens that the median home price, if you brought it down 25%, would be the median income needed to qualify for a home. So like we have this 25% gap between the median income and median home prices in the US. So that's a nice talking point for us, but it really does, impact that qualification. And for other folks that are thinking, hey, yes, I'm going to share some appreciation on the back end of, selling my home in the future, but I don't know what that's going to be. It may not actually be there. And in the meantime, I'm saving 25% on my mortgage. So I'm getting paid appreciation every month, potentially thousands of dollars. Feels like a pretty good option as well.
Yeah, you teed it up nicely for me to ask the question that, I was poking around before we got on, which
Okay.
is what does happen when you, as a borrower, refi or sell your home? Are there complications that borrowers run into that are different from other scenarios? Is it a fairly clean process? How does that work?
Yeah. So with our product, the investing partner is obligated, and again, this is where we sort of act as a servicer, so we'll take care of all of these things, but they are obligated to approve a rate and term refinance anytime and every time that a borrower wants to do that. So if you're not taking out additional debt, you can refi as many times as you want and wherever you want as the borrower and the homeowner. When you do a cash out refi and you sell the home, obviously in selling the home, and we take that first, it's pretty simple. You go through the entire transaction. There are fees associated with brokers, with, could be transfer taxes, could be all those things. There's net proceeds at the end of a transaction that are distributed to the owners of the property. That's the portion that gets allocated between our investor and our home buyer. It's entirely pro rata or proportional to how they contributed on the way in. So everyone's dollar of equity generates the same return on that equity in the future. In a cash out refi scenario, if that cash out is being used to repay the investor, then they don't even need to be, in essence, like involved in that refi. Whatever loan product you'd get in the future doesn't necessarily concern them because they're not going to be an owner anymore, right? So you can pull that cash out and repay them and get into another mortgage product. The little bit of difficulty, perhaps, if you want to pull out cash but not use it to repay the investor, because if we own an asset together and you just want to take out more debt against it, you're basically, diluting my interest. And so it can be done, right? It just requires a little bit of paperwork and management on our part, approval of everybody to restructure how the finances of the home work, but it's possible.
I'm sorry, Jerry, I'm like taking over entirely, but like what an interesting
Perfect.
concept to consider with our, rates have come down some, sure, but we're not where we want to be. Let's all admit that. We started a drinking game at Housing Wire for every time we heard 6%, by the way. But if you were to go into that investment right now, and then in a few years rates do come down to a reasonable place, you could then do what you're talking about, cash out refi, pay back the investor, and now you've got full ownership of. And that's a really interesting like timing play.
We've seen that from a number of loan officers thinking about this as a 2 to 3 year play for
Right.
someone, where, yeah, rates come down a bit. You even see a couple percentage points of appreciation in the home. And now all of a
Yeah.
sudden that equity is there that they need, and the homeowner can access it in a cost-effective way to take full ownership. So that's another thing that we do as Crib Equity and as the partner to both the investor and the homeowner is, so the homeowner will actually have a dashboard, they'll have an account with us. And, in addition to getting statements, they'll also have kind of a portal they can log into at any time. They can see, we have an AVM for them. We know the mortgage balance, we know the splits that everyone has. We can create for them the model around what refinance will look like, and actually also come to them when we feel like there is that opportunity, right? When we understand where rates are and when we think is a prime opportunity for them to actually move into sole ownership. There was a product somewhat similar. I'll say it had some very different components to it also, but Unison had this what was that, 7, 8, 9 years ago, Jeremy, and actually happened to have a friend in my neighborhood here who used it, and that's exactly the scenario that they had. They couldn't afford to buy the house when they got in. They bought the house together with shared equity, or I guess that one was more shared appreciation. But setting that aside, 3 years later they refied out, and basically they realized that they couldn't afford to buy the house 3 years later if they were going in to buy it then, but they could afford to refi out the investor and take sole ownership, because you're essentially just buying half of that appreciation over time, or whatever the percentage is, rather than trying to buy into the entire growth in the market. So as a tool to get into the market sooner, the economics are sort of wildly advantageous to buyers.
Yeah.
Well, I think you've made a good point here in terms of what's next and later is you made the argument that policymakers should understand that there is a 25% value gap between incomes and home values. That makes the policy case. This is a lower risk solution. That makes the investor case, especially that first mortgage investor, in my opinion. Second, you allow, I think, a really strong case for mortgage loan officers who are out there right now trying to make the case that they need to be a home debt advisor, that they need to be a coach, that they need to be a counselor, that they need to be more than just an application taker. And yet, when we introduce this product into conversation often, we get resistance because it is new, or because of what happened 7 or 8 years ago, or these different things. When in reality, we're here to make the case, at least I am, that this is exactly the type of thing mortgage loan officers should welcome, because it makes you more dynamic. It puts you in a conversation about liquidity versus equity. What's the best product for you? What's the best horizon for you on your amortization schedule? And I just think consumers want that control. Yes, like wildly appreciating assets are part of the reason they need that control and they need that tool today. But I think people also want more flexibility. How much home do you want to buy? What do you want in your pocket, in your bank account versus in your investment? This is what we've been doing in almost every other financial services category for the last decade, and it hasn't come to mortgage until now. And so I think if you're a loan officer listening to this, or you are a capital markets person looking to provide that tool, I think you make your loan officers much more valuable to your audience by bringing in new leads that you couldn't convert, and then also reaching out to your existing pipeline saying like, hey, we got some flexibility here. I can offer you something different than your kind of classic PMI product, paying $120 a month more.
Yeah, I think you're spot on from what we see. I mean, the key for the mortgage investors, obviously, our ability and willingness to subordinate ourselves, right? And so that creates the security that you're talking about, and the credit enhancement. I mean, I think it's so interesting on the side of gift funds and gift letters and such. I mean, people are pretty brazen about that. You can find, the New York Times or Wall Street Journal articles where they're like, I borrowed, $300,000 from my parents, and like I'm paying them back at 3% a year or something. Like, that money is getting paid back in a lot of circumstances, right? Even though it's not meant to. At least, in our case, you're contractually limited from that exposure of actually having someone have the cash flow out to repay. So I think those things are sort of interesting. And on the home buyer side, I do think creative loan officers can provide this benefit and the guidance to consumers, because we find that the consumer understands it a lot of the time. Like they know what they want. We're just working with someone who they were buying a house just shy of $1 million, and they could stretch, right? They were really going to liquidate more than they wanted to, use more of the assets they wanted to get to 20%. And then they found us and said, oh, well, we'll put 15% down, right? Because we feel more comfortable if we kept that extra $50,000. And then if you put 15% down, now my loan's at a 70 instead of an 80, and my cash flow is that much better. My mortgage starts with a 5 instead of a 7 or whatever it is. And they're just like, well, this seems like a total win for me, right? I got more cash. I've lowered my payment. This is my first home purchase. I now feel secure in entering into that financial commitment. And so they get it, right? And they'll understand how that resonates for them. And I think there is an ability for loan officers or realtors, anyone in that space, to really work with their clients to understand what it means to them to buy a home and what's important to them, and how they're going to do that comfortably, particularly in this market.
So we
I mean,
see
I guess infringement reasons would cause you not to do this, but I really think you missed an opportunity to call this Daddy Warbucks. I'm just saying.
I mean, there's always a marketing campaign in it, Sasha. That's why,
Can't help myself.
That's right. Exactly.
Equity is a great name too.
Let's figure out the meme, and let's figure out the viral campaign on socials for that one. I love it.
I'll put it here as a now next later exclusive. We did create a tongue-in-cheek meme website called myrichparents.com.
Oh my God, yes.
That we haven't marketed yet, because I hope it's not like too on the nose, right? But it's very it speaks to the difficulty of buying a home. But if you want, there actually is a letter generator on there, so you can go on there and you can fill it out, a few questions, and it'll actually generate a letter for you that you can send to your parent or benefactor or whoever you want about how much money you need and why you need it.
So we find innovation inspirational, which is why we end on later every episode, try to leave a few minutes. Can you just tell us, maybe in the last couple of minutes here, where do you think this is headed? You started the company. You obviously want to work there a long time and see it grow and be really big for the American homeowner, home buyer. Where do you see this potentially going?
Yeah. Well, I think the biggest thing is we want to create more access to homeownership. I think that's becoming more and more challenging. The data obviously paints that picture very starkly. Knowing personally my own difficulty becoming a homeowner, and then the benefits, not only financially, but emotionally and psychologically, of becoming a homeowner, it's so profound that's one of the real driving and compelling reasons to do this. I think later, though, I really see there to be a fundamental shift in the way that we all own our homes, or in the way that we want to own them as a financial investment. So, Sasha asked who our investors are. I sort of imagine a future world where, as retail investors, even as home buyers and sellers, we can engage in that equity differently. So imagine, Jeremy, that you're buying, your next home in Detroit, and you decide that instead of putting all of my money into this home, I want to put half of it here, and I want to put half of it with Crib Equity. I'm going to take some money from them to buy my house, but I'm going to give them that same dollars. And now I can own a diversified pool of assets across the country. Or maybe because I'm in Detroit, I want to buy Florida real estate and New York real estate and Washington real estate, or whatever it is, into vehicles that access that. And so there's this ability for us there's such a concentration of wealth into one home in one market, and the well-being of that, for the family. And generally it works out well, because, real estate tends to rise over time. But I think it is risky for some people. And certainly, as we've seen through the pandemic years, for the last couple of decades, like, the appreciation has not been evenly spread across the market. That's created distortions in where people can afford to live and where they can't. And so I think there is this incredible opportunity to allow people to buy and sell home ownership in a way that can actually serve them better, just the same way that, for a lot of people, an index fund is the best way for them to invest in the stock market, because they don't want to pick individual stocks. Or, if you're getting RSUs at work, you might divest from those because you're already so invested in your company from your paycheck, right? Like, there's a whole bunch of different ways to think about it where you want that diversification. And I think there's ultimately a way to provide that, even with liquidity at different times, on your home equity. It's really fascinating.
Yeah, I
when
mean,
you diversify your investments, it made me think about investor loans. And I understand not all of them are agency approved, but many of them are. And so that just light bulb went off in my head. Sometimes I'm a little slow to the party on a Monday, need more coffee. of using that as a parlay with the agencies. Like how can we get in there and go, okay, come on, if these are the requirements that you need, to your point, you built this to be investor guideline accepted. There's no reason why this doesn't fit into that same bucket.
Yeah.
Agreed.
Well,
And I think that's a concept, Sasha, to your point, that a lot of people, the future customer we're talking about, understands diversification. To Skye's point,
Absolutely.
they've been introduced to diversification in all these other areas, their work life, their investment, 401k or fund contributions. And now we're just saying that's going to also be available if you want in your house. That's all. I like it when innovation is pretty straightforward and commonsensical. So let's do it. Well, Skye, thank you for joining us. We're out of time on today's episode of Now Next Later, but obviously this is a hot topic. So we look forward to bringing you back, bringing others back, and really, digging into home buying in 2025. Sasha, thanks again for everything. It's wonderful co-hosting this with you.
Nice. Good to see you, Skye.
Yeah, thank you both.
All right.
All right.
Have a
Take care.
wonderful day. Thank you, everybody.